Well, we want to keep on the topic of the infrastructure bill, what's happening in Washington, D.C., and how all of this impacts markets with our next guest. George Mateyo is Keep Private Bank Chief Investment Officer, and he joins us now. George, thank you so much for joining us this morning, or this afternoon, rather. And I did want to ask just a little bit about today's market action here. We are seeing stocks trading a bit choppily. We're awaiting some new economic data and earnings reports. Seeing a little bit of movement here, though, in Treasury markets. That 10-year yield is moving quite a bit higher this afternoon. What do you see as being the big driver of the market action today and over the past couple of weeks?
Yeah, thanks for having me, first of all. It's nice to be with you. I think that the market's kind of going through a bit of a transition right now. We've kind of had this really rapid recovery off the bottom from essentially last spring or so, and we've had an epic decline, and we've kind of seen that kind of result in some epic policy measures taking place. Monetary policy was swift and massive. Fiscal policy has also been swift, and it continues, just as based on your prior guess. It looks like it's going to be signed into law today, and that really has a tailwind that could last many years, frankly. And then thirdly, the healthcare response has also been just remarkable. And now we're going through this period of time where we're kind of digesting some of that. Policymakers' actions probably created some distortions, frankly. One distortion we can point to the fact that during the pandemic, roughly 6% of American households lost jobs, but yet 86% of American households actually received some type of stimulus. So we're kind of working our way through that process right now. Some of these distortions are causing some concerns about inflation. Once they normalize, we think that the economy can actually still be quite resilient and really produce some really strong growth into next year and perhaps into 2023 as well.
And George, I want to get your take on what's been happening in the bond market and what that might be signaling about the Fed, because we've seen some big moves in yields to the upside, to the downside, and now to the upside again. I'm looking at the 5-year at the highest since, I believe, February or March of last year, of 2020. So, is the market trying to calculate, okay, the Fed is going to have a lower terminal interest rate that would be on the short side when we see the longer yield coming down? Or is it, in fact, are the market participants pricing in a sustained period of inflation where the Fed really doesn't act that aggressively?
I think what's interesting with respect to the Fed and inflation is that monetary policy and actually the economy are probably operating at two different speeds right now. So the economy is actually coming out of a really strong recovery, and we're still processing through some of those inflationary pressures that you mentioned. But at the same time, monetary policy hasn't caught up yet. So I think the bond market is repricing a bit of that catch up, if you will, and does expect that rates will probably have to come higher next year. But then next year is somewhat of an unknown in the sense that maybe in the second half of next year, as some of these inflationary pressures come off the boil, the Fed might actually have to be in a period of pausing. So I think we're in a really interesting transition right now with the Fed actually being a bit behind. We have to be very careful about policy error, that the Fed doesn't overdo it and overreact, because a lot of these inflationary pressures are really quite nuanced right now. We can actually point to 3 different types of inflation that we probably should be monitoring. One of which is cyclical forces. These are things that are caused by the base effects that should normalize early next year. Somewhat is still dependent upon the path of COVID, and that's still uncertain. Secondly, supply chain forces should also normalize, but probably toward the end of the back end of next year, rather. And then structural forces, and there we're somewhat in a kind of tug of war right now. Wages, for example, as you probably pointed out, have been actually moving higher, and that actually can kind of cause some pressures of inflation to rise. But at the same time, technology and globalization are still forces that are quite strong that actually keeps a lid on inflation. So those 3 forces are things we have to combat, and we suggest that volatility might be here to stay over the next couple months or so as we process some of these forces with respect to inflation.
So, George, you mentioned a potential policy mistake here by the Fed. So is the bigger risk right now that the Fed doesn't move quickly enough on raising interest rates, or that they move too quickly and too robustly in terms of trying to bring in inflation that may already be proving to be transitory?
Yeah, the Fed is in a tough spot because of that. And I think there is going to be some volatility around that between now and, say, the early part of next year. At the same time, there's some uncertainty actually who might be actually leading the Fed. We have to probably get some announcement from that on that front this week. But I think over time that some of these pressures will correct, and I think they will ease a little bit, and the Fed can actually be a bit patient. One thing they've been paying a lot of attention to is the employment sector, which has recovered quite a bit, but there's still roughly 4 to 5 million people who are out of work right now. And that's likely to keep rates lower for longer. So I think the Fed can actually buy its time a little bit, but they're going to have a pretty strong spine to actually navigate the next couple months or so as inflation pressures stay somewhat elevated.
I want to read from one of your notes to us earlier today that you sent over and just get your take on something here. We like high quality cyclicals. We're being super selective in mega cap. We have a slight preference for value versus growth, but wouldn't get overexposed to value. So is the value trade just overdone, or do you see a definite timeline, a window for this trade?
No, I don't think it's overdone. And in fact, again, we still think that there's some legs in the cyclical story that your previous guest talked about as well that actually gives us some confidence that value might actually run a little bit longer. But again, as things normalize with respect to inflation, perhaps in the back half of next year, growth stocks might actually resume some of its momentum and actually propel the market higher in the second half of next year. So we're not really big fans of actually overweighting or really having a big overweight in any one sector or style right now. But I do think you want to be very selective of the market overall. We also think it's not a time to be complacent because there are some risks for a policy area that we talked about. But at the same time, it's not a reason to be pessimist either. Profits are booming right now. We think they can actually stay strong. Economic growth next year should actually be above trend on the back of some further monetary and fiscal stimulus. So for those reasons, and above all else, we would actually advocate for selectivity as opposed to being pessimistic about the state of the economy right now and the state of interest rates going forward.
All right, we'll leave it there for now. George Mateyo is Key Private Bank Chief Investment Officer, and we thank you for being here.